Happy New Year.
Happy New Year to you as well.
You got a busy quarter coming up, don't you?
Oh gosh, yeah, I'm not sure I'm ready yet. I'm trying to be.
Very cool. All right. Well, let's see. You've got a presentation. Would you like to run it? You want me to put it up for you?
I think I can run it. I will do my best to try.
I made you a co-host, so you have rights.
Perfect. Just let me know when you want me to get started, or if you.
Well, let's just get a premise going. So, what's your position on? I don't really want to do that to you. That's not fair. Where are we going tax-wise? Are you think we're going to get more taxes coming or less taxes coming?
Like tax rates themselves?
Yeah.
Oh gosh, that is the ultimate crystal ball question.
Mm-hmm.
I have no idea what is going to happen. I keep getting surprised far too often. What is changing? What isn't changing? I think a lot of it just depends on each individual's personal situation, whether those changes are good or bad. Because I have clients all over the map. Some, if some of the changes go through, are going to be great. Some are not. So
Gotcha.
It's hard. I would say it's individual specific as to whether things are going in the right direction or the wrong direction.
Well, let me ask you this. Last time we got together, we talked about the Foreign Investment and Real Property Tax Act, and we predicted that a lot of foreigners would be coming in and buying U.S. real estate. Have you seen that happen yet?
I usually get picked up on the tail end, the selling side of things. I will say the last week has been crazy for people reaching out, selling property. The borders were from various countries starting to open back up. That's usually a good thing. It seems like maybe with the recent increase in craziness, they might be closing back down again or making things more challenging. So I was anticipating that things would start opening, but the world had other ideas.
Yep. I participated in that. All right, well, let's get started. Help us become tax efficient in 2022 and help us minimize our taxes for 2021.
Yes. Okay. Should I start sharing my screen here?
Yes, please.
Okay. Let me get us going. Hang on. Okay.
Bright green button at the bottom. So there you go.
All right. Do you see my slides?
Yep.
All good? Okay. Sorry, I like to think I can manage technology, but it's kind of, I don't know, I get behind. But anyway, thank you for having me back. Happy Friday to everyone. My name is Chantel Hoffman. I'm a part owner with White Sands Tax Solutions. We specialize in realtors, real estate transactions. We do our best to kind of make things as easy for you as possible. This is my second favorite topic. So my first being Foreign Investment in Real Property Tax Act, FIRPTA, if any of you are familiar with that term. This is my second favorite in just dealing with you guys. There's, in my opinion, the biggest thing that you have or that we need to be cognizant of is flexibility. So I kind of build my practice, my ideas around keeping as many options open for you as we possibly can throughout the year, because we just never know how the year is going to go. You can have a really great month. The next month can be a little bit lower. So if we keep those options open and as flexible as possible, to me, that kind of rules the conversation. There's a couple deadlines coming up I just wanted to mention so that they're on everyone's radar. The first deadline coming up is the 1099 due date. So if you have any contractors that work with you, or you likely are a contractor for another brokerage company, those 1099s are generally due January 31st. If you are making payments to a contractor who is not incorporated more than $600 for the year, you generally should be issuing them a 1099 slip by the end of the month. So please keep that in mind. There's many different options for doing that. Reach out to your accountant. Most of them are equipped to assist you.
Well, let me interject there just for a second. So a lot of our agents are paying transaction coordinators.
Okay.
Right? But we generally, as a brokerage, pay the transaction coordinator for them. We take it off the commission. So they don't need to pay 1099 their transaction coordinators because we are 1099ing them.
I think it would depend on how that's structured. That's a really good question.
So let's use my daughter, for example. She uses a transaction coordinator and she pays her, I don't know, $375 a transaction. And she's probably done 25 transactions this year. So she's paid her over $600. Does she need to 1099 her transaction coordinator? Or since the brokerage company pays it off out of her commission?
So that transaction coordinator, they should likely receive a 1099, depending on how they're structured as well. So if it's just, you know, them as an individual hired out versus they have a kind of business entity around them, I would probably err on the safe side and say that that needs to be issued.
Okay, I'll check with Joy on that.
So you may want to speak with your, you know, a few different parties, just to double check that, but I would certainly look into it and just confirm.
Thanks. I needed more on my to-do list today.
I know. Happy tax season's upon us. So that's the first step. The other thing that I wanted to mention, because I think a lot of folks are aware, but some maybe are not, is the tangible personal property forms are due April 1st. If you have less than $25,000 of, you know, essentially business property, not including your vehicle, at least that first year you should file the exemption form. A lot of accountants do it as part of their tax filings, so it may be on file for you already. But that's just something to kind of verify and make sure that that is on file. That is county specific. So depending on what county you're in, that's the form that you would file. It's a fairly basic form. You just want to make sure that it's kind of taken care of. And then the big fun one is that the personal tax filings, they're opening up January 24th is the first day that we can file individual tax returns. And the due date this year is April 18th. So keep that in the back of your mind as well. Of course, you can always file an extension, but if you do have tax owing, you still want to get it at least a good estimate paid by April 18th to avoid future interest and penalties.
Let me just clarify that for the agents watching, because well, actually it's a double-edged sword, because typically your first quarter estimate is due and your 2021 tax return is due. So you've got two tax hits coming, right?
Correct.
And if you don't, the government, you know, as an employee, taxes withheld from every paycheck. So the government gets paid every week or every 2 weeks. As a 1099, you're not, but you are expected to pay at least quarterly. And if you don't pay quarterly, you're going to pay interest on what you should have paid for that quarter. So this is really part of your planning to do is, and it really sucks. The first quarter sucks because you got to pay 2021's income tax and you got to make your estimated first quarter for 2022 income tax estimate. And if you don't, you're going to get interest on what you should have paid, and they'll assess it backwards later on.
Exactly. So that brings me to kind of my fourth due date that I should mention is that the fourth quarter for 2021, that payment is due January 15th. So tomorrow. So if you had one more estimate, your fourth quarter estimate, that's due tomorrow. So keep that in mind. The good news about all of this is that interest rates are really, really low, and that includes your IRS tax payment. So if you do happen to maybe not know about this or be a handful of days late, you know, try and be on time. But if you are behind, the interest calculation is relatively low. So there is some slight good news there.
You get a lesser penalty.
Exactly. I help out where I can. I try and balance it, but sometimes it becomes challenging to balance the information. So we'll kind of get going here. I just kind of wanted to go over those deadlines so that everyone was aware and up to speed. The main question that I get when I first meet with a realtor is, should I form a business? Do I need a business entity? I usually say, you know, if this is going to be a relatively serious position, you are planning on actually having some transactions throughout the year, it's probably a good idea to get that business entity set up relatively quickly. And it offers two kind of main benefits. When it comes to tax benefits, it's that flexibility. So once the entity is formed, we have some different options in how to treat it, to treat that activity and save potentially on some payroll tax items primarily. The second is liability protection. So what you are really doing when you form that entity is separating your personal assets, your home, your vehicle, your retirement savings from the business activity. So if someone were to get really, really upset with you, and hopefully that's not the case, but if that were to ever happen, you have a separation legally between those business assets and your personal assets.
Let me bring this up right now because Matthew just chatted and I think, and he's asked, what if you already have a real estate investment LLC? I'll answer that for you because under the Real Estate Commission, your entity has to be your legal name. So it has to be Craig Beggins LLC or Craig Beggins Inc. I can't use Craig Beggins Master Realtor of Florida. That's not my name, right? So that's very important that you set up your corporation to be your name. We still have agents that are not doing that. They're not compliant and it's not right. They just haven't been caught yet.
Yes, no, thank you for bringing that up because that is something I've dealt with clients who have, you know, set up the business as not their name. It just causes them problems down the road. So make sure you check, make sure you have the right naming convention. It is very important to avoid future headaches.
So when you said if you're going to consider this seriously and do transactions, I mean, a lot of realtors are, you know, the average real estate agent does 4 or 5 transactions a year.
Mm-hmm.
When the cost involved in setting up a corporation or an LLC and the extra filing benefits or cost of filing the tax returns may not be worth it unless you're making what would you say 30,000-40,000 a year, or would you say more than that or less?
Yeah, that's usually the threshold that we really start talking about the benefits of setting up that LLC, or the business entity, I should say. The liability protection is still, it's almost a personal decision. For some people, it's really important. And I would always encourage, you know, to have that little extra cost. Just so you know that once it's set up, the annual filing fee is $138.75. It's really not that much to have the entity set up and continue with the you know, SunBiz fees. The formation side of things, depending on the route that you go, can be a little bit more costly than that. But yeah, once you're kind of in that 30 to 40,000 of income range, that's when I kind of consider you a little bit more serious into the business, and we can start to do some tax planning, and you'll see some tax savings as a result.
Nice.
Okay, so
Mike, yes, the answer to your question is yes. Michael Claman LLC.
Mm-hmm. So there's really 3 options here, and I'm gonna do my usual "I'm not an attorney" speech. It's not my job to necessarily tell you what is the best option for you. You have 3. You can be a PLLC, a PA, or an LLC. Usually I recommend you talk to, you know, your brokerage. Some of it's based on your licensing, and talk to an attorney and figure out what the best option is for you. This is a legal question more so than a tax question. And so they're better equipped to make that decision for you. My job is just to, you know, allow you to know your options. The legal form itself has very little bearing from a tax standpoint. So this is a legal question, but just kind of know your options. It never hurts to reach out to an attorney and just make sure that you are picking the best one up front.
What would you say most of your realtor clients are?
The majority are LLCs. But you know, is that just because of the time frame that they set up the entity and maybe some of these other options weren't available at that point? Is it just because that is the easiest route to get set up? I'm not exactly sure. I do have a couple of PAs, a couple of PLLCs. But again, it's more the legal side of things, but most of my clients do just have an LLC.
Mike, I can't answer that question. That's tax advice and I can't give it.
So once you kind of have that business entity formed, the next step is to apply for an EIN. It's actually really easy to apply for an EIN. If you are working with an attorney, some will offer this as part of their package. If they don't, you can just go online to the IRS website and apply. It takes about 30 seconds and you have your business ID number. I will say, if you apply online, there's no record of what you put down on that application. So maybe save a screenshot of what you filled in just so you have it for future reference. You'll get the number right away. And then, in a handful of weeks, expect to receive a letter in the mail. Keep that letter, or that is very important information included on there. The next thing, once you have your EIN number, is to go ahead and set up a business bank account. This kind of solidifies that separation between you and your personal assets and your business assets. So this is another really important step to make sure that you are not commingling those items. Pay your business expenses out of your business bank account, pay your personal expenses out of your personal bank account. You can transfer money back and forth between the two. But just make sure that those payments themselves fall under the right accounts.
Do you have a preference if they bank at the same bank?
For me, it doesn't matter too much, but it does make it much easier in most cases to transfer money back and forth between. Usually there's no bank fees associated with just transferring money between those two accounts. So it just depends on your preferences, but it usually makes things simpler to just house it under one banking institution.
Okay.
The next step is to kind of start thinking about bookkeeping, the expenses you're going to track, how you're going to track them. This again is going to be fairly important. You should set up those categories in a way that makes sense to you. They should be there to help you make good business decisions. So if you wait until the end of the year to kind of put all your stuff together, any benefit.
Who would do that?
I know. Yeah, nobody actually does that. We all keep track of it monthly, daily, weekly. But it does help, I especially kind of look at advertising. If you can spend a lot on advertising in different various formats, if you have good record keeping and you know what's happening, you can make better decisions as to, this advertising method is working really well for me based on the cost that I'm paying for it versus this is not. I always try and take feelings out of accounting. So I feel like this option is going really well for me. If you actually put the numbers together, they may show you otherwise. So just kind of keep that in mind. Your bookkeeping is for you to make good business decisions. Secondarily, it should be for your tax return. There's a couple different methods that you can use for tracking your expenses. The first I like to refer to as the shoebox method. That's where you take all your receipts for the year and you throw them in a shoebox or a bag of some sort, an envelope or a Ziploc bag, and then you hand that to your accountant at the end of the year. That's the least desirable method. You should still keep them somewhere. Don't just toss them in the trash, but it's not a great bookkeeping method itself. So it just kind of depends on your budget. That is kind of dollars versus time, because time is critically important to us as well. So you can use a program like Excel to start tracking those. That's a little bit more manually intensive, obviously much cheaper. Or you can set up like an online software. There's a lot of them where you can link your business bank account to that software. It starts to do some of the legwork for you. So it pulls in the transactions as they happen in real time. You can set up rules to say, oh, if I have a transaction at Publix, that's always food for my showings. send it to that expense line or category. And so every time it sees a receipt from Publix or a transaction with Publix, it sends it to that category. You can always change it if, it wasn't exactly for that. But that just takes a lot of the legwork out. So a lot of clients use like QuickBooks Online, Wave, FreshBooks, that kind of thing. And then they integrate a lot of different apps with that as well. Your mileage tracker can be potentially integrated. If you have a receipt scanner in your phone, that can be integrated. So just taking out some of the labor intensive items, but then you have a little bit of an extra cost to deal with. So
Lauren said, I use a business credit card and I get paper statements to easily add up and submit to my account.
yeah, it totally works. It just depends on the individual and how they want to do it. So I always say pick something that works for you. Your accountant should be relatively versatile. We see things in many different formats. It's our job to kind of sift through them and figure out how to interpret that for the tax return. So just pick a method that works well for you, that you can handle, you can keep up with.
Do you generally like the idea of having a business credit card? Because that'll track all your expenses in one place.
Yeah, I mean, business credit cards work great. Some of them come with a little bit of benefit, so take advantage. Make sure they don't get too out of control. But beyond that, they can be a great tool. Okay, so I wanted to put this slide. It's a little bit out of order, but I think it's really important to talk about, and that is, should I be an S corporation? So make sure you understand that like the legal side of what we set up initially, the LLC, PLC, PA, that is completely separate from how we see the entity from a tax perspective. So the default is that it's just included, that activity is included on your 1040 as a Schedule C business schedule, income and expenses. You pay tax on that individually. The S corporation question means that business has its own tax filing, which is separate from yours, but you still pay tax on that entity at an individual level. So it's just a tax election. What we're really doing here is minimizing self-employment taxes. So you still get to use a lot of the same deductions, the same expenses that you would without the S corporation. But without the S corporation, you pay self-employment tax on 100% of your net business income. So let's say the business makes $100,000 for the year. You pay your federal income tax, whatever bracket you happen to be in, let's call it 20% for ease of use. Then you also pay self-employment tax on that income. You pay the employer and the employee side of self-employment tax. The total is 15.3%. So now that's $15,300 of self-employment tax on that $100,000 of income. So now on top of the $20,000 that you would give or take pay personally on your federal income tax, you also have this additional $15,000. So now your total tax bracket is somewhere up around 35%. It adds up really, really quickly. So what we do is we kind of minimize that self-employment tax. Instead of paying it on your full net income, you pay it on a portion, the salary that's issued or allocated to you. So rather than paying self-employment tax on 100,000, maybe you pay it on 50,000 or something a little bit more manageable. You've kind of cut that tax bill in half.
So it's like a paper entry. You're just basically taking your 1099 income, paying yourself a salary for part of it and bonus for the rest.
Exactly. So your federal income tax, it doesn't change. You still pay tax personally on that income. That's not necessarily what we're talking about here. Is the self-employment taxes where you're really seeing that tax benefit. There's different thresholds where we start talking about when the S corporation is useful and beneficial. You have a couple extra expenses on your hands. You have a second tax return. So you pay your accountant a little bit more to file that second business tax return itself. You also pay a payroll processor to actually process that payment, that wage for you. So at a certain threshold, it makes sense. If your business is only netting, 30 to 40,000, you're kind of right at that threshold where the extra expense offsets the savings in payroll tax. So that's usually when we start talking about it. I'm going to stop here, Craig. Is there questions on this aspect? Because this
is. I think I can answer for him though. He said, bonus. No, it says regular income. So you have regular earned income, your 1099 income, but your tax accountant would adjust your tax schedule and clarify some of that as salary, and the rest would be regular income. Or it could be called bonus too, I guess.
Yeah, so the IRS has cracked down on this a little bit. They really want that actual wage to be paid out of the business. So it used to be that, we could kind of behind the scenes just make an adjustment and call part of that a wage or a management fee. That was fairly common a few years ago, but the IRS has kind of come out and clarified and said, no, we really don't like that practice. We want it to be a legitimate wage where the business itself is issuing you a W-2. So I would definitely recommend exploring that and actually setting up the payroll. Once you do it, it's not too bad, but it does take a few minutes to kind of get organized. But the IRS has said, we really want to see that on a W-2.
And it also assumes that you have regular income.
Exactly. Yeah. So, I mean, there's a little bit of a benefit for you as well. So that is.
Kimberly said, can you discuss deductions that are little known or apply to realtors that may be overlooked? That's probably coming up next.
It is coming up. I don't know that we got to the handout in time, Craig, but we kind of put together kind of those common realtor deductions that maybe are a little bit lesser known. On a handout. So I'll send that to you at the end of this presentation. And then if you can make it available for whoever would like to see it, it just goes into a lot more detail on the type of expenses that you may or may not be considering as you're putting together your tax returns.
Gotcha. Nancy brought up, said, I think what you pay yourself, you're taxed on, correct? Say you pay yourself $4,000 a month, much of the rest can be expensed, right?
Well, so I'm going to kind of answer it directly, but somewhat indirectly. So tell me if I missed the mark. Basically, you are paying your federal income tax regardless of whether that money is coming to you as a wage or as a distribution. So the business itself, you're paying tax on the business net earnings. If the business makes $100,000, you pay federal income tax on $100,000. If you issue yourself a wage of $50,000 from the business, now your business is made $50,000 because it has that extra wage expense. But personally, you've received a W-2 for $50,000. So the amounts show up on slightly different lines on your tax return, but your federal tax is still the same. You're still paying tax on the income that you earned. So
you're just getting self-employment tax on your salary.
On that 50,000, exactly. So that's where that distinguishment comes in. But I talk to a lot of people who think, oh, I took money out, that was a distribution to me, that's my wage. It's not your wage. Your wage is something very specific. It goes on a W-2 form. You pay payroll tax on that periodically. It is set up very specifically for you. Let me, hang on, I just want to make sure. Okay, so that's kind of my next slide here. So I'm going to move forward. Reasonable compensation. So what is that wage amount? That wage amount is, the IRS is very, very clear on their guidelines. They say it must be reasonable. That's about all they tell us. So reasonable has kind of, we have to look at different court cases, how they're treating people in your industry, the number of years you've been in business. There's a bunch of different factors that we take into account in trying to help you determine what reasonable is. Usually it becomes kind of a percentage of your net income, a percentage of your gross income. And we kind of look at a bunch of different factors and figure out what that amount should be. We also take into account retirement planning, because some of the tax deferred retirement planning options that you have are based on the wage that you pay yourself. So if we go too low, then we kind of make things challenging for you with contributing to that retirement plan. So usually this becomes more of a conversation that I have with each of my clients to figure out what is the right amount for you. With realtors specifically, your income can be all over the place. So usually we set kind of that annual wage a little bit lower, a little bit just under what we expect. And then at the end of the year, we can do like a year-end bonus. We can do a quarterly bonus just to catch up in case you have, a great month or a great quarter.
It's like a business.
Pardon?
It's like a real business.
Yeah, exactly.
Well, we have people making $100,000 a month. They need to run it like a real business.
Yeah, and sometimes you just have like an amazing month, and just keep in mind we have to compensate for that with your wage amount, and just make sure that that initial thought that we had for your wage is still reasonable. I have a very open line of communication with my realtor clients because things change quickly. So usually we kind of set that amount earlier on in the year, and then sort of mid-year, maybe fall-ish, and specifically like November, December, we revisit those amounts. And if we need to pay a bonus, we make sure that that gets in there to keep you at that reasonable line. Distributions from the business to your personal account. Again, there's not really additional tax on that. The only time there is additional tax is if you take out more money than the business is making. So say you get a bank loan for the business, and then you take that business loan and you put it in your personal account and you don't put it back in by the end of the year, that may have an additional tax associated with it. But in general, I mean, that's kind of your money. You can move it back and forth between the business and personal bank accounts at will. You're not really creating any additional tax for yourself. I just call that cash flow management. So you can move money back and forth to pay your bills. Just make sure you're paying the right bill out of the right account. So any questions here?
I'm not seeing any.
Keep going. All right. So payroll. So typically we recommend that you set it up monthly is probably better. Quarterly is okay. Annually is a little bit less okay, a little bit more aggressive from a tax standpoint, but you can get away with it if you needed to. Usually monthly works a little bit better because that hit to your bank account for those payroll taxes is a little bit less. You can there's a bunch of different ways to set up payroll. You can use that bookkeeping software. So if you pay for a QuickBooks Online subscription, they usually have a payroll module that you can add to it. You can set it up that way. I will say QuickBooks Online has been a little bit glitchy historically. So just keep an eye on it, make sure that it is taking the right amount out at the right time. There's also kind of standalone software companies like Gusto is one that I hear frequently, or you can use an actual payroll company. You can do like an ADP or a Paychex, or pick someone local. So it depends what works best for you. I always like to, especially at the beginning, start out with a real payroll company and a person, not a 1-800 number, so that you're dealing with one individual helping you get set up, making sure all those pieces and the registrations are all in place, so that everything is kind of smooth sailing. Again, we kind of touched on changing that payroll amount through the year, depending on what you need to do based on how the business is doing. And then that bonus to catch up if we need to.
Okay, we're getting ahead of some people here. So Sarah asked, if you're only an LLC, I guess she means without the S Corp election, can you still pay yourself without payroll?
Yeah. So if you are not an S corporation, you don't need to worry about paying yourself a wage. You're just adding an expense with not really any benefit. So you can still distribute money to your personal accounts. It doesn't really matter, because you're still just moving your income from one pot to the other pot. You're still paying tax regardless. So,
So in your example, I'm a $100,000 a year earner, but I could, with the S Corp election, I could take 50,000 as salary. So I'm saving 15.3% of $50,000, which is $7,500.
right.
So I'm going to save $7,500 in income tax, and it might cost me $1,000 to do that, and a little bit of hassle, but I'm going to save $6,500 in my pocket.
Exactly. It is a huge benefit. This is why everyone talks about S corporations. But if you're only making 30,000 for the year, maybe this is your first year in business, you're just kind of testing the waters, it's a second job for you, then those costs are more or less fixed costs. So are you saving $1,000 in payroll tax? We do that calculation for all of our clients. It's something that we talk about with them, and we have a little calculator to help us guide them in the right direction, and say, this is the tax savings for you, the payroll tax savings for you. This is the extra cost to get set up. Is this something you want to do? Is it worth the headache for you or not worth the headache for you? And then kind of go from there, but try and give them the tools to make the right decision.
Gotcha.
Um,
And Regina had a question too. She said, is it just for S Corps or the same for an LLC and a C Corp, moving money between accounts to pay expenses?
Okay, C Corps, totally different. C Corps, your legal, your business, everything structure is different. So in a C Corp, I don't see many of those anymore, because what happens is, even though the overall tax rate is only 21.5%, which it might go up a little bit, every time you take money out of that business, you still have to pay tax personally. So I don't see a lot of C Corps anymore, because you have that double tax that kind of, even though 21.5% is lower, you don't have access to that money necessarily to live. So it's kind of stuck in that entity. With the LLC itself, again, that's just the legal structure. The tax structure can take, an LLC can be a C Corp, it can be an S Corp, it can be a partnership, or it can be a sole proprietor. So it's the legal structure. It's not necessarily the tax structure. We can make elections to kind of make it whatever we want to be from that point, which is weird and confusing, I know. But if it's just a sole proprietor, that LLC on your Schedule C, on your tax return, you don't necessarily need to set up a wage to handle that. You're not seeing any tax savings by doing so. So deducting business expenses, so the business expenses themselves, just remember, they need to be ordinary, necessary, directly related to the business, and reasonable in amount. So what the IRS does is it kind of benchmarks realtors. It benchmarks each category of business, and it kind of sets up parameters on what they expect your expenses to be. If your expenses are outside of what the general people in your industry see, they're likely going to ask questions. That doesn't mean that those aren't true business expenses. Just keep those records and kind of be prepared to explain yourself on why your business made $30,000 for the year, but you had $40,000 in meals expense. They're going to ask questions. If maybe there really was, and you're really trying hard to get it going and you have great records, then you're okay. Just kind of keep that in mind, that's how the IRS looks at it, is they benchmark you against your peers. So a couple of common questions that I run into are mixed use property items. I always try and save as many expenses for you as I can. So, you don't necessarily have to have a business vehicle and a personal vehicle. You don't have to have a business cell phone and a personal cell phone. You can have a home office. These are all like mixed use items. So what you want to do for there is just sort of track or have a pretty good idea of what percentage is business versus what percentage is personal. So you can still pay those expenses. You can still pay your cell phone out of your personal bank account. What we do from a tax standpoint is just make an allocation of, these are expenses that we paid personally, but they're partly business expenses. So that's something that we kind of talk about at the end of the year, and make sure that we've captured all those sort of mixed use items.
When you say entertainment is no longer permitted, what does that mean?
Yeah, so in 2017, as part of the Tax Cuts and Jobs Act, they deemed entertainment expenses not to be business expenses. So if you take a client to a football game, or for a round of golf, if you buy them food there, the food is deductible. The tickets of that event are not.
Huh. Didn't know that.
So yeah, they've kind of, you almost have to separate the food versus the event itself. So you can still pay them out of your business bank account. They just don't have a spot on your tax return anymore. Meals this year for 2020, I say this year, this tax year for 2021 are generally 100% deductible. Typically, they are 50% deductible. So if you need to go back through your receipts that you've kept in that handy dandy shoebox and figure out which were for, legitimate meals, whether you're on the road between showings or you're taking a client out or whatever that happens to be, if you are at a restaurant or catering via a restaurant, those are 100% deductible. As part of one of the stimulus packages, they really wanted to promote people eating in restaurants again, or using restaurants. So there's kind of a one-time bonus for your meals expenses this year, which is a little bit interesting that meals are 100% and entertainment's still off the table.
Crazy. Josiah said, is it a dumb question or not? Can you write off your CPA as a business expense? Yes.
Absolutely.
And you got to pay them a lot too.
Yeah. I mean, but it's kind of like my challenge to myself is to earn back my fees and finding other deductions for you, or changing your business structure, tax structure, so we can save and at least make up my fees for it. So that's always
I have no doubt. And it drives me crazy when a lot of agents try to take upon themselves to do their own tax returns, because the money you spend on a good accountant should save you from what you're actually spending on the accountant.
Yeah.
Said no sporting events. Yes, no sporting events. Mike says you just have to have a very expensive meal and a receipt to back it up. So be careful on that one.
Yeah, just keep in mind, keep those records. If it was legitimate, great. If you were taking your significant other out for a really nice meal and the receipt clearly shows that, you may have a harder time justifying that as a business expense.
So what a lot of people do is they write the client's name they had the meal with on the back of the receipt, so they remember what they did in February when it's December.
Exactly. So the IRS actually requests that that's kind of how you track that. And, so if you kind of get in the habit of just while you're there writing it on the back and stuffing that in that shoebox, it can live there for a rainy day. Just, I prefer not to see the shoebox, but I like to know that it exists and you're keeping those receipts, just not as a bookkeeping method. Automobiles, that's another question that comes up frequently. How to track your expenses there. You guys are driving all over the place. This turns into a giant deduction for you. So I've run the calculation so many times. Typically, mileage wins in just about every situation. So keep track of your mileage. There's mileage app trackers like a Mile IQ. I haven't found the perfect option. All of them I find have good pieces and bad pieces. So find one that works best for you. But keep track of that mileage. That's a huge deduction for you. The only time actual wins the argument is if you buy a vehicle and you write it off in the current year. So as of right now, if you purchase a vehicle in the business name and it has a gross vehicle weight of over 6,000, so a little bit of a heavier vehicle, you can write off the full cost of that vehicle in the year that you bought it. That's
Why I
going
drive an
to,
Escalade.
pardon?
That's why I drive an Escalade.
Yeah, I mean, because you can write it off. That is starting to kind of taper down over the years, but as of right now, you're still at 100%. I think, I'm not sure exactly when it starts. I should know this, but it drops down to like 80% and then 60%. But that's a huge potential deduction for you. The problem with writing off your vehicle is that then you have to keep track of your actual expenses going forward. So you have that big one-time expense, but then after that, you don't have the same level of expenses for future tax years. So it's kind of a trade-off. If you had a banner year, then maybe it makes sense. But as a long-term gradual solution, usually we look at mileage. The mileage rates kind of incorporate maintenance, wear and tear on your vehicle, your fuel, all of those items. So
Dick Wilson said the CPA signature on your tax return reduces your risk of an audit too.
yeah, I mean, I can't really weigh in on that, but it generally helps. We generally know, things like entertainment's not deductible, so we kind of keep you on track, or that's our job, to keep you on track and help you do the right things. And I think the IRS does take that into consideration a little bit when they're reviewing your returns and seeing who prepared them.
Do you like Hurdler for mileage tracking? Have you heard of Hurdler?
I've heard of Hurdler, but I have not looked into it very closely, which I should. I've heard good reviews about it, so I really need to explore that more. But thank you for bringing that up. MileIQ, again, it's a decent app. The thing that drives me crazy about MileIQ is if you sit at a red light for too long, it counts that as a second drive. And so then you have to swipe right or left on a few more or pieces of drives than I would normally want to, but it still does a decent job. There's a lot of options out there. So it's something to definitely explore. It's going to save you time and energy in the long run versus, writing it down on paper and then calculating it at the end of the year.
Dick asks, what is the mileage rate for 2021?
Oh, again, good questions that I should know the answer to. I apologize. It's been historically around 57, 58 cents per mile. I don't think it changed drastically for this year. I think it bumped up a little bit over last year, but I'm sorry, I'm blanking on the exact dollar figure. The last item here I want to talk about is home office. So this again is a common deduction that a lot of people have, especially current world, and you kind of have to be ready and willing to work where you are. If the IRS wants you to have a dedicated space for your home office, so keep that in the back of your mind. There's two ways of expensing your home office. One is the simplified method, where we basically take $5 per square footage of that office space. That's pretty standard. I don't think the IRS is going to look at that unless you're claiming, a massive home office. But there is a cap, I believe, of 300 square feet or $300. Sorry, blanking. There is a little bit of a cap there. The second option is actual. Usually this gives you a greater deduction. So if you're renting, you can write off a portion of your rental expenses, your home mortgage, your property tax, your utilities, your Wi-Fi bill. Definitely take that into consideration. That I kind of categorize more under the cell phone type, where figure out what your business versus personal use expenses. But there's a lot of extra expenses that we can add to your home office, so that you get a decent deduction there.
Your portion of the garage? No.
No, but I mean, I do have a couple of people, depending on how they operate. If you have a closet for staging items, that's part of your home office. So if it's dedicated for items to stage a property for sale, keep that in mind. That's space in your home that you could be using for clothes or toys or whatever else. So, part of your garage may be for storing those types of items. Just, somewhat be reasonable when you calculate that.
From the IRS website, beginning on January 1, 2022, the standard mileage rates for the use of a car, vans, or pickups will be 58.5 cents per mile driven for business, up 2.5 cents from the rate for 2021, which means 2021 was 56 cents per mile.
Mm-hmm. So they do a pretty decent job, I would say, of actually benchmarking that and taking into account, fuel costs and that kind of thing. So.
Very cool.
Okay, last thing I want to talk to you about is saving for retirement. So
this is really important because here's what what I'm telling the agents now is, we're in goal planning for the new year. And I'm telling them, look, a lot of people are not good at setting goals, but goal number one is get rid of any bad debt. Whatever income you make, pay off your credit cards, pay off your student loans, get rid of that crap. Number one. Number two, you really need to have 6 months worth of cash saved up, and it just makes life easier. If you fall behind, you can pay yourself, and all that kind of works. And then number three is then now you start saving. You're not buying boats and cars and toys until all those two things are done. And then this is the third part, which I wish I had started so much younger than I did. My 401k has grown a lot, and it's really providing really good returns. And I don't miss it once I started doing it. So this is really a good thing for you guys to pay attention to now.
Yeah, this is critical, especially if we do that S corporation election. You're putting in less into Social Security. That means you have less available when you go to start taking it out. So you've contributed less. I always say take that money that you're saving in payroll tax and put it into a retirement plan so that now that money is in your control, way better for you. You can watch it grow. That control is very critical. But keep in mind that you've contributed less to Social Security over the years. So you need to have an offset for that. There's so many different plans out there for you. Again, I'm not a financial advisor or wealth management person, but reach out to them as far as the right mix and the right, strategy for you. Something balanced is usually better. Roth, you pay tax now for savings in the future. When you take that money out, you're not paying tax on it. More of the traditional IRA, you're saving tax now, paying tax in the future. So some sort of balance between the two. Right now, your earnings are probably higher. So your tax bracket is higher. The future is tax rates are probably going to go up, but your earnings is going to be less. So have some sort of balance in there based on your personal goals, what you think your retirement strategy is going to be. Are you going to completely cease working, or are you going to just slow down? All of those are important pieces of the conversation to figure out what that perfect mix is for you. So keep that in mind. Traditional IRAs are great, but their contribution thresholds are relatively low. Usually for realtors, I highly recommend looking into a SEP IRA. The key piece of a SEP IRA is that the cost to set it up is minimal. So again, trying to save you money where I can. This is the most cost-effective plan for you. The caveat is if you have an employee, this is not for you. Don't do this if you have an employee, because you have to contribute for them the same amount that you're contributing for yourself. So this only works if it's just you, there's no employees. The max that you can contribute for 2021 is $58,000. You don't have to contribute that much, but that's the room that you have available for you. You can have a SEP and a traditional and a Roth and maximize all of those. So just because you have one doesn't mean you can't have the other and still utilize those. The other fantastic thing about a SEP or a traditional IRA is that you have up until the following deadline, tax deadline, filing deadline, to set them up and fund them. So for 2021, if you extend your tax return, you have up until October 15th of 2022 to contribute back. So again, this is where flexibility comes in, keeping your options open. So you do have some max limits beyond just the $50,000. You can only contribute up to 25% of your wage if you're issuing yourself a W-2, or if you're just, general business on Schedule C, 25% of your net income there. So yeah, so it's a great tool. There's other options available if you have employees. Maybe a simple would be a better option for you. That way you can kind of, have a matching portion, but it's a little bit more manageable as far as amounts. Solo 401k can give you great options as well. You can contribute from the employer side and the employee side, which when you're both is kind of weird, but that's how they set it up. And then if you really, really, really want to get aggressive with your retirement planning, the defined benefit plan it has a higher cost to get set up, but your contribution room is much, much greater. So just depends on where you are, what your goals are. I always highly, highly recommend that you work with a financial advisor. They're really cool tools where they can help you map out your retirement. So you can say, I plan to retire at 65, 68, 70. I expect my monthly expenses to be X. I want to have a vacation property over here. Put all of those into their, timeline, and they can say, okay, if you want to do that, if that's your goal, you need to contribute this now per year, and they can help you set that up. So they have really cool tools available. I definitely recommend working with somebody there and getting their input. They can help you a lot.
Yep. Hashtag adulting, guys. This is what it's all about. Some of our agents, if you're making over $100,000 a year, you should have excess income. And if you have excess income, you're paying a lot of income tax on that. And there's some really cool tools you can put money away for the future. And a lot of you are earning substantial amounts of money right now. So I really, I'll bring out my financial planners for you too, but you need an accountant and you need a financial planner. And there's advice from Father Craig.
Well, and I will say, as part of what we offer to our clients is we'll work directly with that financial advisor. So if they say, hey, we think, they'll give you some options, then we can put that into our tax software and say, okay, if you go with option A, this is your tax savings. B, this is your tax savings, just giving you more tools to make the best decision for you. So that's our job, is to kind of help you make the after-tax determination of what the best option is.
Cool. Why don't you go to your page one of your deck, and because that's your contact information?
This here is my contact information. Please reach out to me. I'm always happy to meet with you. I'm always available to answer questions. I don't charge for a consultation, so please feel free. I finally got my Calendly set up. I'm pretty excited. So you can just, book a time that's convenient for you as well. I will say we are located down in Venice, which is a little bit far, but we can work electronically. We can set up a Zoom or a Teams meeting like this, and it's almost like we're in the same room.
Cool. And I sent you all an email last night, remind you of this meeting. We have a lot of people online today. So you've got this contact slide in your deck because I took a screenshot of it for the email.
Thank you.
That's how Chantel and I met. Chris Reed had a problem with the Foreign Investor and Real Tax Act problem. And I was referred to Chantel, and she jumped in and helped us like a lot. And I thought that was cool. And I said, well, why don't you help us learn about Foreign Investment and Real Property Tax Act? So she came on as a guest. And then I said, oh, also you work, and she specializes in realtors' income taxes. I said, perfect. So let's get that at the end of the year, or beginning of the year. So thank you very much. Very educational. And I hope you guys take advantage of the opportunities.
Yes. Thank you for having me.
There's two more questions real quick. I didn't answer here. Receipts or bank statements regarding food expense and gas. Yeah, keep your credit card statements. They have all that stuff on them. That's why if you have a business credit card, your business credit card statement should only have business expenses on it, and they're pretty well detailed on the things. And then
I'll just respond to that as well, Craig, if you don't mind.
Oh,
the IRS is still a little bit old fashioned. They prefer those paper receipts. So keep those bank statements for sure, but they may want more proof. So if you don't have it, that's secondary. But if you do have, like, keep the actual receipts, they're more detailed. That's
Oh, I
usually
see.
what the
So
IRS requests.
you mean if I buy beer at the gas pump, they want to know that. It's not all gas necessarily. Gotcha.
Exactly. They have more information. So that's usually what the IRS is requesting.
Oh, Virginia, this is complicated. What if you have two businesses? One is a C Corp, your husband is your partner, and you often discuss business strategies, plans, safety meetings, et cetera, during meals out. Is this a deduction?
Yeah. So, I mean, if you're out with your partner and you're talking about business, sure. But keep record of what you talked about on the back of the receipt to show that, this was a business meeting. You discussed business. Don't do it once a week. That's probably too much. Maybe once every 2 weeks, though, it might be. Just make sure that you're actually following that this is truly a business meal where you're discussing business strategies and it's reasonable.
Reasonable. That's a highly definable word.
Yes. Oh yeah. That's all the IRS says about it is reasonable. So, but I mean, we have a pretty good idea of what that is. If you go through 3 bottles of wine for the 2 of you, probably not reasonable.
Hey.
No judgment. This is just from a tax standpoint. You can still do what you want to do. But yeah, just kind of keep it, reasonable cost, reasonable frequency.
Perfect. All right. Well, thank you very much. One more Q&A just popped up. We have weekly meetings, no wine. Okay.
Wait, sorry, what was that?
No, she was just commenting. We have weekly meetings without wine.
Yes, good. then you're in a better spot.
Yeah. Cool. All right. You got our contact information. Happy tax planning for 2022 and 2021.
Yeah.
Thanks, Chantel.
Thank you.
Bye all.
Bye.